Hello and welcome to the Business Standard Morning Show. I'm Ishan Gera and here are the stories for the day.
रामू, दो चाय दे यार।
अरे नहीं यार, एक चाय कॉफी।
We Indians disagree on everything, but we agree. SBI is the banker to every Indian.
SBI का home loan? I agree with you.
SBI is the banker to every Indian.
For most of us, Monday morning kicked off with the news that mortgage lender HDFC Limited was merging with HDFC Bank. The combined entity could be the country's second largest company, surpassing TCS. Deepak Parekh, who oversaw the merger and spent 2 sleepless nights before the big announcement, is a relieved man now. Our next report tells more about the 77-year-old industry veteran who has been at the helm of HDFC for over half a century before finding a home for it.
After turning the dream of owning a home into reality for millions of Indians, in the course of its 45-year journey, Housing Development Finance Corporation has found a home within the family. Those were the words of HDFC chairman 77-year-old Deepak Shantilal Parekh as he announced the merger of the mortgage financier with HDFC Bank, creating a lending behemoth. The merger has been speculated about for more than 2 decades, but is coming to fruition now as regulatory changes have reduced the barrier for an amalgamation. The proposed merger will enable the underwriting of larger ticket loans, including infrastructure loans, an urgent need of the country. The deal will help HDFC Bank to reduce the gap with its bigger rival, the State Bank of India. India's second biggest lender will get even bigger, shrinking its gap with the State Bank of India, whose total advances at the end of December stood at 26.66 trillion rupees. Meanwhile, on a pro forma basis, the merged HDFC Bank's total advances are nearly 17.9 trillion rupees.
All we're discussing from the last few years that India, with Indian economy growing, we need some larger bank who can really support operations and give a scale to the Indian corporates, which are also growing at a much more rapid pace at this point of time. One of that was done by the merger of subsidiary of SBI with SBI. So definitely we have created 2 large institutions post this merger. And from the economic perspective, surely it is a good thing to go ahead and do this because we require a much larger bank to fulfill a need of funding at a much more larger scale. So like you have seen, we have not heard that SBI can go ahead and do the financial closure as a single banker of a project like Navi Mumbai project of Adani. Indian corporate require this type of funding, and our experience of funding from the 10 or 12 banks coming together, normally you create more of a mess. So SBI has that balance sheet. That's why they are able to take that type of risk. Now HDFC also becoming relatively larger in the size and catching up with the SBI. So that is a positive from the economic perspective. We are growing, and with that growing requirement, we need a larger bank.
Deepak Parekh joined HDFC as a Deputy General Manager in 1978, a year after it was founded by his uncle, Hasmukhbhai Parekh. Not only did he leave a plum job at Chase Manhattan Bank, but also took a 50% pay cut then. Parekh built HDFC into a top housing finance company. Under his leadership, HDFC forayed into areas like banking, asset management, life and general insurance, education finance, and real estate venture capital. HDFC Bank was born in 1994, and Parekh roped in Aditya Puri to lead it. Puri retired as the MD and CEO of the bank in October 2020. Known for his outspokenness, Parekh became the go-to man for policymakers. He expressed his views openly, be it on the policies of the government or the Reserve Bank of India. Parekh also emerged as India's most authoritative voice when it comes to ethics and best practices in banking, making clean business a cornerstone of how the HDFC group functions.
Yes, so under Deepak Parekh's leadership, like we all know, the HDFC group has achieved great heights. It's become India's most successful financial services conglomerate. And very importantly, it's dominated virtually every segment that it has ventured into since its inception in 1977. Whether it be mortgages, banking, the insurance industry. While doing our research on Deepak Parekh and the HDFC Group, we've seen a consistent pattern of prudent and smart capital allocation. It spans across both human and financial capital. On the financial side, whether it be putting up 100 crores for HDFC Bank as capital when HDFC Limited itself only had a net worth of rupees 100 crores, or all the M&As and IPOs of the HDFC Group companies, which have created lakhs of crores of value for HDFC shareholders. As per our count, he's taken 5 companies public. He's completed at least 8 M&A deals. This will be the 9th one. While HDFC Limited had a brand name, it built a brand name on mortgages. All the other businesses where it has dominated and where it has created a lot of value, it could not have been able to do so without the ability to pick and handpick leaders like Aditya Puri or Amitabh Chaudhary for HDFC Life. Every transaction that the HDFC Group has been involved in has seen a certain degree of fairness for both parties involved, whether it be M&A transactions, IPOs, developing talent in-house or grooming talent, or whether it be getting people from outside. So for instance, even during the HDFC Bank IPO, while bankers wanted to price the issue at a premium, it was Deepak Parekh who said that we better do it at par and leave some value on the table for investors. I think the HDFC Limited, HDFC Bank merger is a fitting final tribute, is a fitting last move by Deepak Parekh before he retires. As it ticks all boxes of fairness, I think it's for the first time that at least I have seen where a merger is announced and both companies see an increase in their share prices by 10%.
Deepak Parekh's reign at the helm of HDFC is scheduled to end soon. He would be ineligible to serve on the bank's board after the merger, owing to RBI's rules on age limits. By bringing HDFC under the fold of HDFC Bank in his final act, Parekh leaves a legacy that will probably be impossible to match in India's financial services sector.
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं? ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं? वो तो सबसे आसान है। तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
HDFC merger may trigger consolidation in the banking industry, which is now recovering from the effects of the pandemic. Meanwhile, fresh cases of Covid-19 dropped below the 1,000 mark on Monday, the lowest since April 2020 when it all began. The signs of recovery are all over now. Markets are buzzing with life, airports and hotels with travelers, and gyms with fitness enthusiasts. Schools too have reopened. But at the same time, fresh cases are also surfacing in some parts of the world. So what is the road ahead for the country? Can we afford to lower the guard? Watch our next report to know more.
Over 2 years ago, on January 30, 2020, as the winter was slowly giving way to spring, a news from Kerala sent the chills down the spine. COVID-19 infection had finally arrived. A student who had just returned from Wuhan University in China had tested positive for the virus. It was 2 months after the virus had surfaced in China. By January 30, China had reported 130 deaths, and WHO was yet to declare it a global health emergency. For everyone, including the scientists and health experts, the first wave was like a journey into the dark. As the virus spread its tentacles, Kerala announced a lockdown on March 23, 2020. The nationwide lockdown came on March 25. A country of 1.4 billion people came to stand still. But it didn't stop the march of the virus. According to government data, the first wave spurred a rise in fatalities around June 2020. And the peak daily deaths went past 1,000 in September. Vaccines were not available by then, and the virus claimed over 1.55 lakh lives in the country in the next few days. Vaccination in India began from January 16, 2021, and by February 2021, daily cases had fallen to 9,000 per day. But the worst was yet to come. The second wave, which started somewhere in the mid of April 2021, soon took the country in its grip. Hospitals ran out of oxygen and patients of hope. According to the government data, at least 3.24 lakh people lost their lives, a figure which many believe was an undercount. But the third wave has been the most forgiving, with over 11,000 deaths, and most of them were unvaccinated. The combined death toll due to the COVID-19 is 5.16 lakhs as on April 4, 2022. The economic consequences of the pandemic were no less devastating. The Indian economy contracted by 7.3% in the April-June quarter of fiscal year 2021, the worst decline ever observed since the government started compiling GDP stats quarterly in 1996. The informal sector of the economy was the worst hit as millions of migrant workers returned home. Almost all the sectors were in crisis as domestic demand and exports sharply plummeted. 2 years on, the country and its economy are limping back to normalcy. Fresh COVID-19 numbers have hit a low of 913 cases. At 12,597, the active case load is also the lowest in almost 2 years. The WHO has also said that the acute phase of the pandemic could end by the middle of this year. But for that, around 70% of the world has to be vaccinated. India, on its part, has set a record of sorts. Over 84% of India's 94.47 crore of estimated adult population is fully vaccinated now, while more than 92% have got a single shot. It has also relieved the vaccine makers who had ramped up the production on a short notice and churned out crores of doses, potentially saving millions of lives. Now they can divert resources to make other vaccines too. Economic activities are back to pre-COVID days. International flights have resumed and the tourism industry is bouncing back. But can we lower our guard? Clearly not. Fresh cases of a fresh variant are spreading in parts of the world. In China, thousands of army men and health workers were rushed to contain the virus in Shanghai last week. Fresh spurt in cases were reported in some European countries too.
Now we know that India's population has developed immunity, received vaccines, so there is a hybrid immunity. And the BA2 variant, which is causing a fresh surge in other countries, has already affected India's population. The Omicron surge in India was due to BA.2 variant. So when we put all of these together, like there is no guarantee, but we can be fairly confident that the fresh wave would not emerge in an immediate period. We do not know what might happen after a few months or when a new variant, which is more transmissible or has a severe disease outcome, emerges. So we know 60 plus population are high risk, so they are being already given booster shots. But healthy adult in 18 to 60 or all adult in 18 to 60, especially those who have received both shots or possibly past infection, are protected for some more time. So we should not be rushed to administer booster. Understandably, most of Indian states have reduced or removed majority of restriction, including some states making mask voluntary. I think that's the right step. Essentially, all of the COVID-appropriate behavior cannot be continued forever. They should be very dynamic, agile, dependent upon the risk associated. And those who are willing will continue to wear masks.
Meanwhile, as the immunity obtained from vaccines or infections wane, people, especially the vulnerable section, will need booster shots. India has so far approved 9 vaccines. Several developed countries either have started or are weighing the option to administer booster shots. The US has expanded eligibility for booster shots to all fully vaccinated adults. In India, the booster shots are only being administered to elderly and frontline workers. Experts suggest that it should be extended to all before another wave strikes. An IIT study suggests that the 4th COVID wave may hit the country in June.
क्या हाल? मत पूछ यार,
फिर से स्टॉक्स में फंस गया। तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर। इसमें बहुत तामझाम है। तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Meanwhile, sticking with the merger story, HDFC Limited shareholders will get 1.68 shares of HDFC Bank for every share held. While the merger will increase the bank's product portfolio and ability to cross-sell, there are some financial and regulatory concerns that investors should know. Our next report tells more about it. The announcement of HDFC and HDFC Bank's merger took everyone by surprise. The street on its part gave thumbs up to the merger, with shares of both the financial entities skyrocketing up to 16% intraday yesterday. The merger, if it sails through, will create India's biggest financial behemoth by market capitalization. However, the key word here is if the merger sails through. In an unexpected announcement on Monday, HDFC Bank said that it will completely subsume its sister firm HDFC in a share swap deal. The shareholders of HDFC Limited will receive 42 shares of the bank for 25 shares held, and existing shareholders of HDFC Limited will thus own 41% of HDFC Bank. Shares held by the housing finance company in the lender will be extinguished, making HDFC Bank a full-fledged public company. However, the merger will have to stand the test of regulators, especially the Reserve Bank of India and the insurance regulator.
RBI, if you remember, RBI did not allow Axis Bank to go and buy Max Insurance because it was running foul of RBI's norms of banks holding significant chunks in insurance companies. That's why they have basically said that we want to have a holding company structure, and we would rather that the holding company has is the holder for the stakes in insurance companies, etc. Now, when asked, both of them, they were quite blasé that even here, I think there are precedents, and so we need to see, because the precedent I would cite is Axis Bank not being allowed to go ahead with the Max merger. So why should it be any different? So what I'm saying is that why should RBI carve out special dispensation for HDFC Bank? So there will be an overhang in terms of on the HDFC Life stock.
Back in 2020, the banking regulator did not allow Axis Bank to single-handedly own a significant stake in the life insurance firm. This precedent, analysts believe, could prove to be true for HDFC-HDFC Bank merger as well. Presently, HDFC owns nearly 48% stake in HDFC Life. If the combined entity owns a bigger share, the merged entity might have to pare its stake over the next 15 to 18 months. Currently, banks can either own more than 50% stake in an insurance company, but they have to trim down the stake over a period of time. Moreover, RBI has been mulling a cap of banks' ownership in an insurance firm at 20%. All these regulatory requirements, analysts say, will have to be watched. That apart, analysts say investors need to be cautious as far as FPI inflows in the merged entity are concerned. This is because domestic mutual funds right now can hold 10% of their entire corpus in a single entity. The third overhang could be on the financials. According to early estimates by global brokerage Macquarie, HDFC Bank will have an excess SLR CRR asset requirement of around 70,000 to 80,000 crore rupees and will need an incremental 90,000 crore rupees agricultural portfolio to meet PSL norms. These low-yielding portfolios, the brokerage says, could be a drag on the merged entity's P&L. Refinancing HDFC Limited's funding with low-cost deposits will be another key factor for the success of the merger. Analysts fear HDFC Bank's effective CASA could go down to 35% from 47% post-merger. Investors therefore should be patient in order to accrue benefits from the proposed merger.
If you look at the outstanding loans of HDFC Bank and HDFC Limited, you get a 50% upside straight away. from about 13 lakh crore of advances of HDFC Bank. With the merger, it can go close to 19 lakh crore, 19 trillion rupees. So, in the market, the size always gets a better valuation. Second, if you look at the banking credit growth, which used to be in double digit several years back, now it came down as low as 5% during pandemic. Now it has picked up to close to 8%. But still it is in single digit, and there are no visibility of this hitting double digit soon. But if you look at the housing loan segment industry, it is most of the time it is in the double digit. So going forward also, the housing loan can continue to grow in double digit, which means HDFC Bank can improve its credit growth further. Of course, it is outstanding performance within the banking industry. We saw today 21% loan growth of HDFC Bank. Now, with addition of home loan business, this credit growth can be much faster than even 21%. Third, HDFC holds about a 25% stake in bank. So obviously, these shares have to be extinguished, in my understanding. And if that happens, it will be EPS accretive, book value accretive for HDFC Bank. So therefore, from all these three perspectives, I think it's a great opportunity, beneficial opportunity for shareholders of HDFC Bank.
From a valuation standpoint, analysts say HDFC Bank's valuation can jump from less than 4x price to book value to 5 to 6x price to book value in 1 to 2 years. Against this backdrop, the two stocks movement will yet again be the key driver for the markets on Tuesday. Besides stock-specific action, and other global cues will guide the indices. The benchmark S&P BSE Sensex and the Nifty 50 indices ended above their key psychological levels of 60,000 and 18,000 yesterday, sharing the merger.
अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
After the banking industry, let us move on to the future of technology. Next-gen data center and cloud technologies have announced to invest rupees 1,300 crore to set up 236 edge data centers across India. RailTel too has decided to create several edge data centers in the country's rural and semi-urban areas. On the face of it, this sounds like a run-of-the-mill investment in connectivity infrastructure. But there's more here that meets the eye. Let us find out why.
Edge data centers, as the name suggests, are located at the edge of the network. They are relatively smaller facilities placed close to the population they serve, and their job is to deliver cached content and cloud computing resources to end users. This enables edge computing, which involves processing data and services as close to the end user as possible. This also allows a company, say a telecom services provider, to improve its customer experience. Typically, edge data centers are connected to larger central data centers or even multiple data centers. But one may ask, that's all wonderful, but why is this important to me? And what's new about this? The answer lies in the role edge computing and edge data centers will play when it comes to 5G. Let's go back to the concept of edge computing. Edge computing is a distributed IT architecture wherein data is processed as close to the originating source as possible. Because the processing takes place close to the end users, services are delivered faster and with minimal latency. Fast services and minimal latency. Where else are these terms used prominently? 5G, of course. When it comes to 5G, a decentralized cell network composed of edge data centers will provide low latency in use cases involving high device density. And it is this low latency, apart from higher data speeds, that will be the game changer. Latency is a measure of the time between the sending of a piece of information and the corresponding response. Still complicated? Let's understand this concept by way of an example. Latency is the time gap between the moment you command a remotely driven vehicle to stop and the instant in which it actually starts to apply the brakes. Reducing the latency gap from hundredths of a second to a few milliseconds can ensure faster reaction time for driverless cars, thereby making them smarter and safer. And it is edge computing that will enable 5G to deliver on its latency and bandwidth promises. Since data packets will not have to travel far all the way to some centralized point, applications such as cloud computing, Internet of Things and augmented reality, all of which have low latency and high bandwidth requirements, should be able to deliver an experience that satisfies the 5G customer. Simply put, if you want to experience the full potential of 5G, ensure that there are enough edge data centers around.
यार आइसक्रीम खाएं? नहीं यार, कुल्फी।
We Indians disagree on everything, but we agree. SBI is the banker to every Indian.
अरे SBI contactless debit card? I agree.
SBI is the banker to every Indian.
The country has around 80 third-party data centers and they're expected to see investments of around $4.5 billion by 2025. That's all for today. For more news and analysis, log on to businessstandard.com. We'll be back tomorrow with our next episode. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.